Yields drop. You had a big move in the 2-year. The peak rate is now under 5, about 4.90, as Leisman was talking about. This is a good day for people like you with your view.
It is. I don't mean to be provocative, but it's just this is what a soft landing looks like. This labor report is job growth. OK, that's one of the Fed's mandates, right? Maximize employment. And it's declining inflation in terms of average hourly earnings coming in better than expected and prior months revised down. That's what a Goldilocks soft landing looks like. So if you're a bear, you know, this is a good day to call in sick. Not a good day to be short the market. What this means is that the Fed does not have to be as aggressive as is feared. Now, will they possibly snatch defeat from the jaws of victory? I don't know. You can't rule that out with this Fed. But they should be looking at this and saying, OK, lowering inflation, economy is strong. Scott, did you notice that Atlanta Fed GDP was revised up?
But you're painting this as some sort of major game changer. It's one report that suggests that wages are slowing
you think I'm
gradually.
Exaggerating? You think
well,
so?
I kind of do.
Well,
why aren't you? I mean, they're slowing gradually. Yes, of course it's important. But, you know, look, I don't know, how many more Fed heads do you need to come out and say the same thing? Bostic today, above 5%. Kashkari, Esther George.
That would be unwise.
But, I mean, they may make a mistake. But it's Kashkari this week, Esther George, Bostic.
They may choose to snatch defeat from the jaws of victory. If you look at the last two CPIs, and we'll get another one next week, let's see if that comes in better than expected. But you're looking at month-over-month increases in headline CPI, 0.1, 0.2%. That's exactly where they want it.
Okay.
I'll grant you, there was a big inflation mistake made a couple of years ago. It's taking some time to unwind, but the fact is, it's unwinding.
Bryn, what do you think?
I think it's way too early to say this is a soft landing. The Fed is still flying the plane 40,000 feet in the air, and they're probably going to miss the whole airport, okay? And so we still have multiple Fed meetings, as you said, Esther George, Neel Kashkari. And once again, I'm just going to take what they're saying at face value, that they're going to still go further until the data tells them otherwise. To me, the strong GDP and 3.5% unemployment says we still have further to go. I will say that from an inflation perspective, all that matters is month over month. Mm-hmm. So if anyone's looking at annualized, I say throw it out the window. Because in April, May, and June of 2022, Scott, we were getting 1% prints month over month. And that's really when the Fed realized, hey, we're way behind. Now we're getting 0.1% prints, 0.1, 0.4. And so inflation is definitely coming down. But where I anchor on is that in 73, 74, or 74, 75, whichever 2 years, that you had rates come down, and then guess what? They went right back up. And I think that the Fed has said they are going to go further. Mm-hmm. And so I still think from a portfolio positioning, which really all that matters, you've got to stay defensive.
Because, Rob, Citi today does just that. They downgrade U.S. equities to underweight. The good news, peaking rates. They say there may even be cuts later in the year. OK, that's optimistic. That's what you hear from people who are bullish. The bad news, they suggest, though, is EPS, earnings per share, is contracting. And what the Fed has already done is enough to mean that earnings are going to contract even further. We still haven't had much filter through the system other than the obvious effects in real estate, where mortgage rates react more dramatically, more quickly. Mm-hmm. What do you make of that? Their call.
Listen, I think they're pretty right. We've been cautious. We continue to be cautious. I think you've got two things working against the market. The one is a Fed that is going to continue to stay engaged. I think it's too early to break out the champagne for Jimmy here. They've gotten a Goldilocks print today. We'll get more information next week with the Atlanta Fed tracker, where they look at wage growth, and we'll see. But you hit the nail on the head. Earnings coming in acts as a ceiling for valuations. You got the Fed, you've got earnings coming in. And so the way we've told our investors to play this is if we break 3,800, it's been a meaningful support level. We think we're going back to 3,600. You talked to Lee Cooperman yesterday about this. I think there's a higher probability of that than there is testing the highs.
And he gave you probabilities, right? He said, since you mentioned him, he said a 50% chance that we stay in the range of 3,600 at the low and 4,400 at the high, a 5% chance of going above 4,400, only 5%, and 45% that we could go into the low 3,000s.